Good evening, everyone. Myself, Ram Kumar from HDFC Mutual Fund, welcoming you all to this webinar on our launch of triple NFOs on smart beta ETFs. So the NFO is opening on 9th September and it will run till 20th September. So as you all know, smart beta ETF sounds, maybe it will sound complicated for many of us, but these are very simple offerings. First of all, as you all know, ETFs are passively managed funds tracking an index. So we have three NFOs and all of them are ETFs tracking a particular index. And all of them are equity indices. So these are all equity products. So as you all know, equities is a very basic asset class. And for long-term investing, for wealth creation. So for all those objectives, you can use these three NFOs. And so when we say smart beta, we mean ETFs that invest in equity indices that are built using some factors like quality, value, and growth. Now that also sounded complicated. To make it simple, let me tell you this way. So in a plain vanilla index like Nifty 50 or Sensex 30, the stock selection is based on simply the size of the companies, and the weighting is also based on the size or the market cap. But here, these ETFs or these indices are built with a slight difference. It's not just based on size, but certain factors, as I told you, quality, value, and growth. So these can also be called as some styles. I mean, somebody will say that growth is a style of investing. Value is a style of investing, or quality. So quality businesses is one kind of investing. So there are these three indices that are built by NSE. So quality index, value index, then growth index. So these three ETFs will simply track these indices. So it is actually a very simple concept, even though it overall sounds technical. So we will all explain this thing in detail, for which we have the fund manager with us, our senior fund manager, Mr. Krishan Kumar Daga. So he will be the fund manager. So he'll be the main speaker of this webinar. I also have my ETF specialists, Shikhar Sethi and Siddharth Gupta, who are also part of this call. So if there are any questions that come up on the technical aspects, etc., so we'll be able to handle that. So we will keep this discussion not very long. We'll try to finish it maybe by 45 minutes or so, including a Q&A part. So if there are any questions, I'll invite you to post your questions on the chat window or the Q&A window that is specifically there, so that we can address at the end of the session. So with that, I'll hand it over to Mr. Krishan Kumar Daga, who will take you through the presentation of these three NFOs in detail. Sir, over to you.
Thank you, Ram. Thank you so much. And good evening, everyone. And I just quickly summarize the three NFOs, which is there: HDFC Nifty.
Sir, a little louder, please.
Sure.
Little louder.
Three ETFs which we are launching: HDFC NIFTY100 Quality 30 ETF, HDFC NIFTY50 Value 20, and HDFC Nifty Growth Sector 15. From their names, it is very, very clear from where we are selecting the stocks, how many stocks will be there in the funds. For example, if I say HDFC NIFTY100 Quality 30 ETF, which means that my universe is Nifty 100, and I will be selecting 30 stocks out of which is having where we are using some quality parameters. Similarly, for Nifty 50 Value 20, it's a Nifty 50 index from which we'll be selecting 20 stocks. And Nifty Growth is a slightly different kind of product, where we'll be selecting sectors first, and then from those sectors we'll be selecting 15 stocks which are growth oriented. I will certainly let you know a couple of more details about these funds in the following slides. So first of all, why smart beta investing is so important. When we are comparing with the normal ETF, let's say, which is mostly, market cap based, and at the time of allocation, we might be using the free float market cap strategy, which decides at a stock level what weightage a bit we will be giving to each stock and how the investment will be. But here in a smart beta, the selection process is slightly different. Though these ETFs are also passively managed, all the ETFs are passively managed, but the stock selection method is slightly different here, because there are certain metrics which we are using. For example, when I'm talking about the quality ETF, there is a NSE is having one index, NSE quality index, where they are using four metrics. So they are using the four data points for all 100 stocks, which is return on equity, debt to equity, and earning variability. Similarly, for the Nifty value, they are using different parameters, which is price to earning ratio, price to book ratio, dividend yield, and return on capital employed. So these are the four fundamentals based on which they select which 20 stocks are the better ones. They just, of course, they just some weightage is provided to all these four parameters, which I will talk in the following slides. And the last one, which is a growth, where we are buying the companies which is having a consistent profit growth, like so the growth oriented companies are only selected, but the number of companies will be here 15. So this is how we are selecting. These ETFs are factor based ETF, we can call it. And whether it is quality, whether it is value, whether it is growth, they are having different style of basically selection for stocks. But the allocation, as I said, here it will be slightly different. It is not the way it is in the normal indexes, for example Nifty and all that, where selection itself is based on the market cap. Here the selection process is different, but at the time of allocation, again we are using free float cap market cap methodology. But again, there could be each index may have a certain percentage of the limit. For example, here the 15% is a cap when you are investing in a quality, and for example, you are when you are investing in value, or let's say growth, but in the quality there is a capping on the stock is a 5%. Again, all these things we will talk in the following slides as well. So let me go to the next slide. Why smart beta investing? So when we are talking about smart beta investing, stock selection and weighting based on factors rather than size. As I said, here we are not selecting stock based on market cap. Here we are selecting based on the factors which we are using. So this provides better risk adjusted return compared to the broad market cap weightage indices. So in the following slides, we will see that as well, that how these factor based indices are performing compared to, let's say, broad based weightage indices. This is very popular. If you see globally as well. For example, if I take the size in 2017, it was only 500 billion AUM, which was using the this smart beta strategy. But in last 5 years, that size have grown up to 1.36 trillion. So which is having almost 22% of the CAGR. There is on this slide we have given certain research notes as well, link we have provided, which is also showing that this methodology is better if you are investing through let's say factor based strategy compared to the broad based indices. Just to understand a little bit more about the quality, value, and growth factors. So what are the quality factors? For example, when we are selecting stocks which is having a better efficiency, or you can say lower financial leverage, stable earning growth, these are the all quality parameters based on we are supposed to select the stock. Similarly, in the value, stock which is based on the price to earning ratio, price to book, dividend yield, and return on capital employed. Quickly, I would like to tell you here that when I am talking about this valuation ratio, which means that when you are buying these stocks and at what price you are buying ultimately, whether it is a reasonably valued, or in terms of valuation it is expensive, in terms of valuation it is cheaper. like that. So it is very, very important. There are, certain, investors who want to invest in those stocks which are valuation wise attractive. So here, we are, taking the Nifty 50, which is as a universe. So which is a all, large cap companies are there. But within those 50 stocks also, we try to, select the 20 stocks which are better in these, four parameters, which is price to earning, price to book, dividend yield, and ROC. Again, at the time of selection, in the following slide, I will talk about the weightage which we are using for each of the parameter. Now, if I talk about the growth, in the growth, we are simply taking, two parameters here, price to earning and price to book ratio, but which is, also reflecting ultimately, your earning growth potential. So here, you are investing in those companies which are investing in the growth, where the higher growth is there. So all three, strategies are different, and different investors may use, different strategies, or sometime you may invest, in all three strategies as well. If you want to, let's say, take participation in all three, because quality is having a different parameter, value is different, and growth is different. Now, why we are investing in these three, kind of strategies? For example, if I take the quality, which is, showing relative outperformance during broad market weakness. So, with name also, it is very, very clear why, quality, because whenever there is a some sort of, challenges we have seen in the past in the market, in those times, your quality stocks will always outperform. So historically, we will, compare some of the incidents in the following slides where, quality is performing better, especially in the those time when market is not stable. Similarly, for the value, it is a consistent performer across variety of, market environments. Now, value is a different, kind of, product, like where we are, anyway, we are having, 20 stocks out of, large cap Nifty 50. So this, theme, is most of the time, all the times you can say, or most of the time, people always, trying to find, good quality stocks, good, liquid stocks, but at the same time, they want to, try to, get where the valuations are attractive. So that's, the theme here we are having. In growth, we are giving exposure to those stocks which are consistent and giving positive earning growth. So that is the criteria, one of the key criteria which we are using here. We are following, in the quality, we are following the Nifty 100, TRI, which is our universe. I've told you earlier as well. And in the value, we are having Nifty 50 TRI, and growth also, we are having, returns which we are comparing. It is, in the following slide, we'll see it is better than the Nifty 50 TRI also. What is the methodology? It is very, very important to know, whether it is quality index, value index, or growth index, what are the methodology behind that? So as I said that in the name itself, it is very, very clear that what is the universe. When I'm saying Nifty 100, which means that, universe is Nifty 100. When I'm saying name is Nifty 50 Value 20, which means that universe is Nifty 50, like so. Similarly, eligibility criteria for the index, which is also very important from, especially from the liquidity point of view. So for example, even if we are having Nifty 100 as a, universe, but we select only those stocks out of Nifty 100, which is a part of the FNO here. So that we have to know here that we are not, using all the 100 stocks unless they are part of the FNO. Similarly, for the Nifty 50, anyway, all Nifty 50 stocks are the part of FNO. So that criteria is also fulfilled here. Only for the growth, sector 15, though, we are saying that stocks with FNO, but positive EPS is also very, very important here. And the dividend norms, which is IRDA have defined, that is also it. The selection process needs to meet that. So it has to comply with, all those criteria here, not only, with the FNO. So metrics which we are using, this is again, very, very important to know. For example, in the quality 30, we are using return on equity, we are using debt to equity ratio, and 5 years EPS growth variability, which means that change in the basically EPS growth for 5 years. So that's the one we are using. Nifty 50 value 20, I have already explained price to earning, price to book, dividend yield, and ROCE. Nifty growth, again, we are using price to earning, price to book, and EPS growth frequency. Here, price to growth, I mean, frequency, when I'm talking about in the growth, it is very, very important how, I mean, that they are considering this EPS growth frequency. For example, at the time of selection of sectors, they are checking that Nifty 50, I mean, whatever, let's say, I mean, stocks are there, first of all, in the sectors, 3 times out of 4 observation over the last 2 years, that is what, I mean, they are selecting. So, which means that only those sectors which are giving you positive, I mean, basically observation, not only positive, I mean, the best one as well. So 3 out of 4 times, I mean, it has to be, I mean, better or higher than, I mean, basically your Nifty, I mean, 50 P and price to book both. Only those stocks are shortlisted here. From these sectors, once your sectors are defined, basically, because first you select your sectors and then within that sectors, you select the stocks. So within that, then you, I mean, select the stock, top 15 stocks. For example, let's say based on, I mean, market cap, assuming I'm just giving an example, let's say there are 50 stocks. Out of 50% of the total, I mean, your universe, you will select as a stock across, let's say, sectors, whatever sectors you have selected. Then out of that, there is, I mean, 15 stocks you are selecting. So 50 stocks, 25 is your, I mean, basically your list, first of all. Out of 25, again, you will see wherever you are having 3 positive observation out of 4 observation. So it's slightly, I mean, tricky the way, I mean, stock selection or sector selection is happening here. But even, I mean, if you see, I mean, what, I mean, let's say active fund manager do, I mean, active fund manager is also having certain style of investing, how he's selecting the, I mean, let's say sectors, how he select the, I mean, stocks within that sector. He's also having certain style. The style from scheme to scheme or fund manager to fund manager can be different. The only difference between, I mean, active funds and the smart beta ETF, here it is a predefined methodology and you will always follow that strategy for the longer period. I mean, you are not changing your style, but in the active, time to time you may change. I mean, the style of, I mean, let's say investment is not, I mean, predefined. Here it is a predefined, I mean, strategy. So that's the one, I mean, difference between the active, I mean, fund and the smart beta, I mean, ETF. But there is a certain style is definitely there. As I said that here also you are using the certain fundamental. Here also you are using the sector selection process and stock selection process. So it's, I mean, well defined here. Number of stocks, again, as I said in the name itself, it is, I mean, existing 30 stocks because the quality 30 when we are saying it. So here we will be having only 30 stocks. In the value 20, we will be having only 20 stocks, and the growth sector 15 will be having only 15 stocks. So growth, I mean, sector 15 is a very, very concentrated, I mean, portfolio here, because when you are having only 15 stocks, definitely there'll be, I mean, exposure to the 3 or 4 or 5 sectors maximum. You may not have, I mean, exposure to all the sectors. So because ultimately first selection is happening at a sector level and then it is happening at a stock level. The sector also should have, I mean, that growth, I mean, numbers, as I said, I mean, at the time of selection. Weight and capping is also, I mean, quickly, I mean, I will tell you, in the quality 30, I mean, weight is, I mean, calculated from a quality score and then a square root of free float market cap. But again, as I said earlier, that here, I mean, capping is there at a stock level, it is 5%, or, I mean, it is a 5 times of the free float market cap weight. So these are the two, I mean, condition is there. So here you are not, I mean, simply, I mean, investing on a free float cap, market cap based, I mean, like other, I mean, broad based indices. In the value 20, it is simply, I mean, free float market cap based, but again, stock is capped at a 15%. So capping is there. Unlike your, I mean, broad based indices where there is no capping. Similarly, in the Nifty growth, again, I mean, stock is capped at a 15%. And the allocation will be based on the free float market cap weight here. This slide is just showing you, I mean, top 10 constituents of each, I mean, index. And on the left hand side, there is a sectors weightage is also shown for all, I mean, 3. And it is also showing compared to, I mean, let's say Nifty 50 and Nifty 100, how you are overweight or underweight. For example, I'll just take one example here because rest of the numbers you can, I mean, see in the presentation. For example, information technology. For example, in the Nifty 100, we are having 25%, Nifty 50 Value 20, we are having 39%. In the growth, I mean, we are not having at all. At the same time, if you compare with the index, broad-based indices, Nifty 100 is 13.5 and Nifty 50 is 15.1, which means that Quality 30 and Value 20 both are heavily overweight on the information technology at this point of time. So there could be, I mean, because of your predefined strategies, the weightage, I mean, could be very, very different compared to your broad-based indices. So that also you can compare, I mean, each and every sector here. There will be some of the sectors where your exposure is, I mean, not there at all. I mean, for example, in the Quality 30, metals, power, consumer services, construction, realty, all these sectors are not even existing in that. Even in the Nifty growth sector, there are many sectors which are having zero weight compared to your, I mean, broad-based indices. This slide is showing you quality, value, and growth indices versus Nifty 100 TRI performance since inception. So here again, I mean, I will take, for example, one example. Let's say if I talk about the either for the 10 years or let's say since inception, if I compare, let's say Quality 30, which is giving you 14.5%, I mean, return on a 10-year basis. Value, I mean, 20 is giving 16.4, and Nifty growth sector 15 is giving 14.5. Now if I compare with the Nifty 100, I mean, or let's say Nifty 50 TRI, which is Nifty 50 is, let's say, for example, 14%. So on a 10-year basis, all three, I mean, strategies are outperforming the Nifty 50. So that is very, very important when you see, I mean, how, I mean, this smart beta can do, I mean, better than, I mean, compared to your broad-based indices. But here I would like to add one thing, that when we are talking on a long-term basis, let's say 10-year or 12-year, yes, I mean, these three, I mean, indices are outperforming broad-based indices, but in between the returns could be very, very different because it is not necessary that it is always or it is all the times like, it is outperforming. But yes, in a long term, I mean, these three strategies, we are having a past historical data which is showing that these three strategies are outperforming. Same thing, same performance. I mean, now if I compare on a year-to-year basis, so for last 13 years, here we have given the data for Quality 30, Value 20, and growth sector 15. And then we have also compared with the Nifty 100 and Nifty 50. So data is on the left-hand side table, but on the right-hand side, I can show you, I mean, one thing. When we are doing analysis of, let's say, for Quality 30, we are having data of 12 years, but for rest of the two strategies, we are having data for 13 years. Now, if I compare with the, I mean, Nifty 100 or Nifty 50, the outperformance is amazing. I mean, for example, if I see the Nifty 50, and then if I compare with the Quality 30, there is just 7 times out of 12 years when, I mean, Quality 30 is outperforming. Now, Value 20 is amazing result. I mean, out of 13 years, 11 years it is outperforming. So out of 13 years, 11 years, your Nifty Value 20 is giving you better return. The returns, of course, are on the left-hand side table, but I'm just sharing on an overall basis this data. Similarly, for the growth is, I mean, mix of, I mean, basically output. I mean, if you compare whether, I mean, let's say Nifty 100 or Nifty 50, both the times it is outperforming 8 times, though, I mean, number is 62%, but then again, we will see, I mean, here the return, I mean, on a year-on-year basis, if you will see, it could be, I mean, slightly more volatile compared to, I mean, your Nifty 50. Why I am saying so? Because, I mean, on a long-term basis, yes, your strategy is doing better, but on a year-on-year basis, I mean, because your allocation is only in the 15 stocks and it is very, very concentrated. So sometime, I mean, your returns can vary from your, I mean, broad-based indices. This table is, I mean, basically give you very, very clear picture compared to, I mean, let's say when you are comparing 1 year, 3 year, 5 year, 10 year, all, I mean, 4, I mean, periods which we are comparing here. And here, all three strategies, whether it is Quality 30, Value 20, or Growth Sector 15, all three strategies for all the times are outperforming Nifty 50 index here. I'll take one example here. Let's say if I'm talking about 10 years, when your, I mean, Quality 30 is giving 13% return, compared to 11.4% in Nifty. Similarly, Nifty 50 Value 20 is giving 13.9% CAGR compared to 11.4% in Nifty 50, and even growth is giving 13.6% return, which is 11.4%. As I said, here your portfolio in the growth is very, very concentrated, but still, when you are looking at a return on a long-term basis, this is, outperforming the Nifty 50 for sure. Similarly, here we have given a standard deviation of rolling return and return risk ratio. If I compare return risk ratio, let's say of these three strategies is slightly higher compared to Nifty 50, but whenever you will see whenever you will chase, let's say, higher return, there will be a time when your return risk ratio could be higher. So here also, basically quality, if you will see the return risk ratio is 7.6% compared to Nifty 50 4.5. But if you see the Nifty 50 Value 20, it's quite closer to Nifty 50 that way. Even the Nifty growth, which is slightly higher compared to Nifty 50 Value 20, but Nifty 50 Value is very, very close to that. And that way, if you compare the return, which is 13.9 versus 11.4, and if you see return risk ratio, which is 5.08 to 4.5, if you compare these two numbers, definitely Nifty 50 Value is far big difference in that strategy compared to your Nifty 50. As I said that when we are talking about a smart beta, the fundamentals are very, very important, because there are certain strategies which we are using. So here it's always better to compare the valuations and the fundamental ratios. For example, if I compare the price to earning ratio, I'm just taking one example here of Nifty 50 Value 20, and I'm comparing with Nifty 50, which is the last column. For example, Nifty Value 20, if I look at the P ratio, 17 times it is trading at right now, compared to Nifty 50, which is 20.7 times, which means that on a price to earning parameter, Nifty 50 Value 20 is attractive compared to your Nifty 50. Similarly, price to book, if you see, slightly, it is, expensive compared to your Nifty 50, but then these are the stocks which are, doing better. And if you are getting at a attractive valuation, the price to book is not, much of the difference, but yeah, still there's a small difference is there. But these stocks are giving you higher dividend yield as well, because dividend yield here is 2.9% compared to Nifty 50, where your dividend yield is only 1.3%. The last number is a return on equity. Now, return on equity is 25% for these Value 20 stocks compared to your Nifty 50, where aggregate number is only 18%. So on all four parameters, if you see, Nifty 50 Value 20 is, looks better compared to Nifty 50 indices here. Now, if I can talk about the other Quality 30 and Sector 15. Quality 30, when I'm talking about, I will quickly say one thing which came up in my mind, that whenever you are going to buy the quality stocks, of course, you will not you will be not getting at a cheaper valuation. Of course, you have to pay little higher valuation. That's why Nifty 50 is 20.7, but P of Quality 30 is 30.7, which means that it is expensive. But always, quality is, quality stocks are never, available at a cheaper valuation. It is always expensive compared to your value, or if you compare with the broad-based indices, it will be always, better. It is higher, but at the same time, return on equity, this is a one parameter I wanted to highlight. In the Quality 30, it is the highest. So it is giving you 30% return on equity compared to your 18% only in the Nifty 50. So quality stocks will be always, having a higher, ROE. Though PE or price to book could be expensive compared to the broad-based indices, but ROE is always higher. But there are certain investors who want to buy the quality stock. For them, this index is more, I would say, advisable. Here we have given couple of incident, what happens whenever there is a stress in the market. So how these three indices, which we are, or three ETFs which we are talking about, are performing in the market stress. I'll take again one example here. For example, if I take an example of the COVID case, In the COVID times, if I compare the period, let's say from mid of the January to March 20, when your market have started falling in the expectation of, COVID, and the expectation of, let's say, lower, growth of the market, of the companies, of the sectors. So market, broadly, if you will see, let's say whether it is Nifty 50 or 100, they were down by 32%. But at the same time, if you see the Nifty 100 quality index, that was down by only 26.5%, which means that outperformance of almost 5.5 to 6% kind of. Similarly, if I take the value 20, they were down by only 24%, which means that outperformance of 8%. Now, here I would like to add one thing, how we recognize that these indices are better, because at the time of stress, because when market is doing well, there could be certain stocks which are extraordinarily expensive in terms of valuation, but still because of the demand, prices goes to the roof. But at the time of stress, you get to know the reality, how the stocks are performing, how the sectors are performing, which index are doing better. So we have, why we are coming out with this, three studies, because we have realized all three strategies are doing far better at the time of no stress. Whenever there is a market stress, these three indices are doing better. Not only during the stress, even in the long term they are doing better, but in between, of course the return could be very, very different if you compare with the Nifty 50 or Nifty 100. But at the time of stress and at the time of long term, if you are seeing, let's say, 5 year, 10 year, of course, these three strategies are giving you better performance compared to the large cap indices. This slide will make it further clear how the performances are. For example, if I take, let's say, all three indices, now let's say I am not very clear which strategy is more suitable in what time, because at different time different strategies can work, like so for a common man, it could be difficult to decide whether I should invest in quality, whether I should invest in value or growth, or what time I should invest in which strategies. So it's better, let's say we have taken one example where somebody who is investing one third in the each strategies, and then let's compare the return, how the returns will be. Again, I am taking one example here. For example, if I take the 10-year return, and let's say you have invested one third in each of the strategies, your average return is 15.3%. Now if I compare that return for the Nifty 50, it's only 14%. And if I compare with the Nifty 100 also, then too, I am outperforming, because Nifty 100 is only 14.5%. My return is 15.3%. Even on a long term basis, I've invested in all three strategies, which means that I'm not, taking the best of the advantage for all the, categories here, but I'm investing one third in each. But despite of that, I am outperforming the broad-based market here. Now, if I compare the rolling return, let's say rolling return, if I see for, combined strategies, and if I am investing, let's say, for 10 years, if I could have invested 13.7% is my return. If I compare the rolling returns with, let's say, Nifty 50, it's only 11.4%, which means that there's an alpha of 2.3%, which is used if I compare with the Nifty 50. Even, if I compare with, let's say, Nifty 100, 11.8% is a return, which means that almost 2% I'm outperforming to Nifty 100 as well. So these strategies, one thing is sure, like, that they are outperforming, whether I take it, let's say, I have taken in the previous slides, I have compared each financial year, and we have seen that out of 13 years, 11 years, there is a Nifty 50 value 20 is outperforming. Similarly, 7 times, we are outperforming. The quality 30 is also outperforming 7 times. So we have seen financial year wise, we have seen on an overall 1 year, 3 year, 5 year, 10 years. Here we have taken a strategies where I am investing one third in each. Then what happens? So we have seen, various kind of, combination we have seen in terms of performance, and we have compared with the broad-based indices. But at the conclusion, every time we are reaching at a conclusion that these strategies are doing better. And on a long-term basis, again, I'm repeating that, because performance of various factors changes across different market, environment. So not necessarily that every time these three strategies will do better, But yes, on a long term, and whenever there is a stress, we have seen historical data is very, very clearly showing that you are outperforming. So we suggest that, I mean, investor can consider the diversifying their investment across these factor based indices. Of course, they have their own choice. I mean, if they like value more, growth more, or quality more, they can pick, I mean, and they can, I mean, give the weightage accordingly. But if, I mean, they don't want to, I mean, let's say, take a decision which strategy is better, at what times it is better, if they are unable to, I mean, let's say, figure it out, then if even if they are investing, I mean, let's say one third in each, still, I mean, you are generating better return. So this, I mean, slide is very important from that perspective. Quickly, on the why we are investing in this quality, value, and growth, I mean, smart beta ETFs. It is, of course, backed by empirical research. I mean, so there's a lots of research, I mean, is done behind creation of these indexes. The average rolling return, we have already seen, it is better, and it is, you are diversifying across various factors. So each, I mean, index is, I mean, using different factors for selection of the stock. So when you are investing in these three strategies, you are, I mean, diversifying your portfolio as well across various, I mean, strategies. Now we are talking about how, I mean, HDFC Nifty 100 Quality 30, Nifty 50 Value 20, and Nifty Growth Sector 15 can make difference, I mean, to your portfolio. So first of all, why ETFs? When so far we were talking about the index strategies, I mean, how these index are, I mean, created, and how we are investing in those strategies. Now, I mean, I will take 1 minute here to, I mean, say that why we are investing in ETFs, because it is simple. It is very, very simple, and it is liquid, and it is diversified. So it is important, I mean, that whenever we are investing in these strategies, we should know, I mean, that it is easy to understand. So if whatever strategies, if it is easy to understand, then it is, I mean, better. Liquidity is very important because you can sell quickly and efficiently on the stock exchange whenever you want. So here, I mean, these ETFs should be, I mean, very, very liquid, and you should be able to sell that. And diversification, again, I will tell you, I mean, I'm not talking about diversification across, let's say, stocks or sector. I'm talking across funds, because it allows you to build a portfolio with the expected risk and return which suits you better. So here you can, I mean, decide that what sort of risk is suitable to you and what sort of return you are expecting. Now if you are thinking, I do not want to, I mean, invest in a growth, but I want to invest in a quality, or you want to invest in a value, I mean, picks, or you want to take a decision that you want to invest in the growth. And unless you are, I mean, able to decide that which study is better at which time, then you can decide one third in each. And we have already explained about that. Multiple reasons for investing in HDFC ETFs. Values, because investors' first approach of HDFC mutual fund, and we really thank you for your trust in us. And the process for which HDFC is very well known, that we are always client focused, and experience comes with a highly disciplined and robust investment and risk management policy and processes. Now processes always they describe how things are done, and how, I mean, we differentiate, how we focus to make them better in the future. So that's why, I mean, process is very, very important, which we follow at the time of investment, at the time of creating the liquidity, etc. So that process is very, very important here. And we have an experience of 20 years in managing passive funds. We are managing since last 20 years. So that's about us. Outcome, ultimately objective is that, I mean, we want to, I mean, track the benchmark, and we want to keep the minimum tracking error, and we want our performance in line with the benchmark. That's our, I mean, focus, that's our aim, and that is what outcome will be here. About the funds, most of the things I have already explained, but quickly I will tell you investment objective here. Whenever you are investing, let's say in quality 30, you are, I mean, having an objective to, I mean, basically get the equal return to the Nifty 100 Quality 30 index. And of course, subject to the tracking error, of course, subject to, I mean, TR, etc. So, and then that is our objective. Same thing for the Nifty 50 and growth sector as well. Our investment strategy, I mean, I've already explained in the index slides. Uh, we are managing it passively, so which means that whatever weightage will be there in the index, and the same weightage, I mean, at the time of your investment will go there. So that's how it is. This slide will tell you a couple of the fun facts. For example, at the time of when we are creating the unit size, I mean, here it will be on the day one. I mean, your investment, let's say units which you will be getting, it will be 1 divided by 100 of the index. So for example, let's say quality index right now, if it is at a 3900 levels, so which means that your NAV on day one should be 39. I'm just giving these numbers as an example, but this is how it will be. And similarly, I mean, for the Nifty 50 Value 20, where your index is 8,800, so your investment will start at a 88 rupees. So just think from a, I mean, investment perspective, for especially from a retail perspective, that you are, I mean, taking in the exposure best 30, I mean, let's say quality wise stocks at just, I mean, 39 rupees. Similarly, for the value 20, where at 88 rupees, I mean, when you're buying one unit, you are getting the exposure. And same way for the sector 15, I mean, ETF, where the value will be around 87 rupees, like that.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.